Hello guys, welcome back to the next series. In this series, we are going to solve the ISC Specimen Question Paper 2023. This is going to make things easy for you and help you understand things at a conceptual level. Alright, and these things are important for you to prepare for your upcoming examinations because a lot of things are there which are important for you guys to know at a concept level. Alright. So in this video, we are going to solve the MCQs and the short questions as a part of question number 1 and question number 11, both from section A and section B. Okay. So the first question that we have is an MCQ, and this is on partnership. A firm has an unrecorded liability for workmen compensation for 10,000. The firm was not prudent enough to create a workmen compensation reserve. How will this liability be treated in the books? Now, since this is already classified as unrecorded liability and there was no reserve, so nothing to be adjusted from the reserve, straight away this will be treated as any other unrecorded liability, will be debited to revaluation account, and the workman compensation liability account will be credited, right? So option C is the answer for this one. The second one that we have got, Neptune Limited, an unlisted manufacturing company, has to redeem its 3,000 7% debentures of 100 each on 30th September 2022. Now again, first check that you have to run is whether an unlisted company, manufacturing company is required to have a DRI. Okay, that is important. Now, on this, I have made a separate video for you to help and make things easy for you to understand what all categories of companies are required to prepare DRI and DRR and which companies are not required. Unlisted companies are required as per the guidelines. So we have the provisions of Companies Act. The question says on which date should the company invest. Now the date to be noted is the redemption date. This is getting redeemed on 30th September 2022. As per the rules, the DRI to be created at the beginning of this financial year when this is getting redeemed, right? 22, that means it should be created on or before 30th April 22 itself. All right, be careful. Next one, when a partnership firm dissolves, its losses, including deficiencies of capital, are to be paid first out of. So this is straight away paid out of profits of the firm. That's the guideline. Okay, next one. For a company forfeits 1,000 shares of 10 each, it had received 6,000 rupees on these shares, right? What is the maximum discount that can be allowed by the company on the reissue of 400 shares? First thing, step one, calculate what is the per value of amount forfeited, that is per share. How much was forfeited, which is 6,000 divided by 1,000. Straight away, 6 rupees was forfeited. Okay, first calculation is 6 rupees. Now, the maximum discount which is being talked about here, the maximum discount that can be allowed is the amount which you have forfeited per share. That is a maximum discount. So 6 rupees have been forfeited. 400 shares are the value. So straight away the calculation should be 400 into 6, which is 2400. Okay, straight away. So in that case, my answer is 2400. Okay, straightforward. Keep your concepts clear so that you can do them in no time. Number 5. What is the accounting treatment of employees' provident fund appearing in the balance sheet of partnership firm at the time of dissolution of firm? Here, the first journal that we have is like any other liability, employees' provident fund will be transferred to realization account. So the journal is employees' provident fund account debit to realization account. Okay. Now, the second part, as any other liability, this has to be paid off. So realization account debit to bank account. Again, if no information is mentioned, then it will be paid off at book value. If any other information is mentioned in the question, then that needs to be followed and respective amount to be put here. This is the treatment. Point number 6, give any one important feature of non-purchased goodwill. Let's have a look here. Non-purchased goodwill, it is the value of a business in excess of the fair value of its net tangible assets. This is also called the inherent self-generated goodwill, inherent goodwill of the firm, and it arises over a period of time due to good reputation of the firm due to various factors, and it is never recorded in the books of accounts. Okay, any of the features you can pick up and mention. Next one, number 8, mention the heading and the subheading under which calls in arrears and calls in advance are shown in the balance sheet of a company prepared as per Schedule 3. Calls in arrears, main head, shareholders fund, and subhead is share capital. It is shown as a deduction from subscribed capital. Okay, that is important for you guys to know. That is shown as a deduction. Calls in advance, it is shown under current liability, main head, subhead under other current liabilities. Okay, this one is done. Next, we have give one difference between securities premium reserve and premium on redemption of debentures. Right? Premium reserve, securities premium reserve, it's a capital profit of the company. However, premium on redemption of debentures is a capital loss for the company, as premium is received during issue of shares or debentures. So this is an inflow and it is paid by the company while redeeming shares or debentures. Then this is an outflow. Okay, anyone you can write. Next, number 9. Question number 9 is again the same sum that you find in specimen paper 2024. This same sum has been given there as well. That's why it's important to solve the historic questions as well. Joy and Deb were partners sharing profits and losses in the ratio 2:1. They admitted Gopi into partnership for one-fifth share. At the time of Gopi's admission, furniture book value was this, which is reduced by 40%, and machinery book value of 1,50,000 was reduced to 40%. So here, if it is reduced to 40%, that means it was reduced by 60%, right? This is important to be noted to be able to do it flawlessly right first time. Okay, so now let's do the calculation here. As you can see, it's already done. For furniture, the decrease in value is 40% of 2,50,000, right, which is 1 lakh. And for machinery, the reduction is 60% of 1,50,000, which is 90,000. So total reduction is 1,90,000, right? This is what we have to do. The question asks the net decrease in the value. Okay, that's important. So net decrease is 40% and 60% total 1,90,000. Next one that we have, Gabby Limited, a listed NBFC, has 30,000 5% debentures of rupees 100 each for redemption at par on 31st March 22. Again, a listed NBFC, this is required to have DRI, so DRI is applicable. Here, the realized date of redemption, it was redeemed at 102% less 5% brokerage. So we are required to calculate the sale price of the debentures. Before that, we have to calculate the face value of the debentures, which is 30,000 into 100. That's coming to 30 lakhs. That is the face value, first step. Now, this debenture DRI has to be 15% of the face value of the debentures which are getting redeemed by the end of that financial year. So 15% of 30 lakhs is 4 lakh 50,000, right? Now these are redeemed at 102%. So the gross value of this is 102% of 4 lakh 50, which is coming to 4 lakh 59,000. Then there is a brokerage of 0.5%. And remember, brokerage is always calculated on the gross value of the debenture redemption investment. Okay, don't end up calculating on this. So gross value is 4,59,000. 5.5% of this is 2295. So the net selling price of the DRI is this minus this. So 4,56,705 is the answer here. Okay. So these were the questions from part A, section A. Let's move on to section B now for the short questions there. Question 11, part 1. We have a ratio sum given to us. Let's do it. What will be the operating ratio of Zinnia Limited from the information given below? The revenue from operations is given as 90,000, so 9 lakh. Let's plot that. Then the gross profit, it's given 20% on cost. Okay, 20% on cost. However, we don't have the cost price, we have the revenue from operations, which is the selling price. So if 20% on cost is given, that means what? This is 1/5 on cost, right? 20%, 20 by 100 is 1/5. Now, as per the rules, 1/5 on cost, it means 1/6 on revenue from operations or selling price, right? SP, you can say. That's the rule. Okay, straightforward. If you use unitary method, if you use X to do the calculation, you will get the same result. This is a direct way of doing it and it saves a lot of time. So in that case, gross profit will be 9 lakhs into 1 by 6, 1,50,000. Okay. In that case, cost of goods sold will be 9 lakhs minus 1 lakh 50, 7 lakh 50. Operating expenses are given as 60,000 in the question. We are required to calculate operating ratio. The formula is given as cost of goods sold plus operating expenses by revenue from operations. You should be aware of this formula to make things easy for you. So 7,50,000 plus 60,000 by 9 lakhs. Okay, so let's solve it. 7,50,000 plus 60,000 divided by 9 lakhs. How much do we get? That gives us 90%. So 90% is the answer for this one. Number two, how is interest paid on debentures considered in a cash flow statement? Interest paid on debentures, this is considered to be as financing activity. Okay. Though don't get confused with this option. Even though we add it back from the net profit before tax, we add it back there. However, it is not considered as an operating activity. It is a non-operating activity. That is why it is added back and it is a financing activity. That's why it's classified under the head as financing activity. Okay. Point number three, state the objective of calculating liquidity ratios. Why do we calculate that? What information do we get from liquidity ratios? They are a measure of the ability of a company to pay off its short-term liabilities. They determine how quickly a company can convert the assets and use them for meeting the dues that arise in a short span. The higher the ratio, the easier it is the ability to clean the debt and avoid defaulting on payments. That's better for the company. All right. Number four, mention the accounting basis on which cash flow statement is prepared. There are two bases of accounting generally we come across. One is the cash basis and the other is accrual basis. Cash flow is prepared on cash basis of accounting. Okay, so this is the answer for this one, cash basis. And the last one that we have, what is gross profit plus cost of materials consumed? This is the formula for sales or revenue from operations, as you say. All right. So these were the solutions to the short questions. Hope this was helpful. Hit the like button if it really helped you and do share with your friends. We'll catch you all in the next video with the next set of sums that we have. Thanks for watching. If you have any questions, do let me know in the comments box below.